Hello.
Hi, Gina. How are you?
I'm good. How are you?
Good, good.
Good.
Well, well, we are going to do our Facebook Live, right? We have a couple of people here.
Awesome.
I also have my mic on, and I want to welcome all of those who have attended our first Facebook Live. I have with me the guest speaker, Gina Peterson, who is from Movement Mortgage. And the reason why I selected her to be the guest speaker today is because she's very knowledgeable about mortgages. And if you're thinking about mortgages now or in the future, if you have a question, you want to know about student loans, ratios, all that great stuff, this is the perfect time to get yourself aligned in order with what you want to do for your future. So Gina is here. She's going to provide us with free services and give us her expert opinion and advice on things in the mortgage. So I want to welcome you, Gina, and thank you for your time
Thank
because
you.
time is valuable. And Gina is also an expert in the industry. She has over 20 years in the industry of mortgage lending. So, Gina, let me give you a little opportunity to give your own bio to everyone,
Sure,
if you
sure.
don't mind.
Yes, thank you. Thank you so much, Felicia, for sharing your platform with me. I so appreciate it. And for everyone on Facebook, my name is Gina Peterson, and I've been a lender for 20 plus years. Um, During those 20 years, I was a broker and I was a correspondent lender, and now I am a direct lender at Movement. Movement has the capacity to lend in a variety of ways, from the not so seasoned home buyer to the seasoned investor. So I'm excited to be there. I've been there for a year now, and I look forward to sharing my information with you this evening.
Perfect. Thank you. Thank you so much for that insight for our listeners so they can have some insight about what you are and what you do and how you be able to help them with some of their questions they may be having.
Sure.
Well, I'm a stickler on time, so it's 7:01.
Okay.
We had our brief introductions, so I'm going to go right into just questions and answers. I have about 10 questions that were emailed to me. Or text to me, but I see people coming in. So I want to give people an opportunity to ask their questions in the chat. You can just type your question in the chat and then I will read it for you because you cannot come on the chat, but I can definitely read your questions. I'm going to start with one of the questions I have, Gina.
Sure.
Let's see.
Da, 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 da.
Da, 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 da.
And I just want to say that none of these questions have been given to me in advance.
Absolutely not. We do not play like that. This is the reason why we have you on live to put your questions in the chat where everybody can see them and she can answer away. That's how we roll for real in 2025. Okay. So here we go. Because I have a couple of them. All right. So here we are. All right. Here we are. Got a lot of questions here. All right. Here's a question. I don't see anything rolling in the text right now, so I'm going to go with this question.
Okay.
Okay, this question, I'm going to leave the name anonymous, but this question is coming in from a homeowner. They said that they have their mortgage low enough that they can honestly pay it off. They want to know, is there a benefit in doing that, paying off their mortgage now? That's one question.
Well, it's according to what your future plans are going to be. Um, if you have, when you have a mortgage, you're paying interest. So that is a tax benefit. But when you have no mortgage, there is no longer a benefit because there's no mortgage interest attached to it. So you have to decide on what your reasoning is to do that, whether it be just to have no mortgage, or you're planning on moving and you don't want to have that lingering debt. It depends.
Okay. Next question. What are the current rates for taking out a line of credit against your home? And if you have excellent credit score of 820?
Rates are running in around mid sevens. It's anything better than what the credit cards are charging, right?
Mm-hmm.
So, and it's over a longer period of time to pay that off when you have a line of credit. There's a couple different lines of credits that people may partake. One of them is a line of credit where they're using it as a credit card and paying it back, and are able to go back to it and continually pay it off and use it, pay it off. And then there's another one called home equity loan, where you get that money in a lump sum and have that monthly payment. And you get that lump sum to do whatever you need to do with it, but it's closed, so you can't tap back into it once you've paid it down. So again, with the home equity line of credits, you have to decide on what is the purpose of having a home equity line of credit. What are your plans?
Okay.
Hmm.
Okay. Thank you for that.
People also will refinance cash out as well instead of a line of credit, because they just want one loan. They don't want a mortgage, and they don't want a line of credit. They don't want two loans. So they'll just do one loan altogether, and that's a refi cash out.
Okay. Refi cash out. Okay. Okay. All right. So I didn't mean to bring you on camera, Lisa. I think only person I have brought on camera, my intentions were just to bring Gina on camera. But as you can probably tell, I'm asking your questions. Okay. The next question I have is, can you take out a line of credit to pay off your mortgage and still have a mortgage? Will you?
No, no, because the line of credit will be paying off the mortgage, and you'll just have the line of credit as a standalone, you know? Yeah.
But
So for instance, if you owe $50,000 on a mortgage and you get a line of credit for 100,000, you take that 50,000, pay off the mortgage, and then you have the remaining $50,000 to use, but you still have that $100,000 in debt.
say that again.
You would still have that line of credit of up to
Oh,
$100,000.
that you're responsible for paying
Yes,
off.
of
Right.
course. It doesn't just go away, you know. You have to, pay back that $50,000 that you've used from the line of credit to pay off the mortgage.
So it probably would only make sense to get a line of credit if, in fact, the line of credit interest rate is lower than your current mortgage rate, correct?
Correct. And or if you're getting a line of credit, a lot of people are consolidating debt. So they're using their equity to pay off all the debt that they have, to consolidate, because the payments on the credit cards could be significant. I had one person, they had $15,000 a month in credit card debt. And we were able to consolidate all that in a refi cash out, not necessarily a line of credit or a home equity loan, but we did a refinance cash out,
Mm-hmm.
and he was able to pay off all of it. And now he has his mortgage, which is around $7,000, and doesn't have any monthly recurring expenses.
And what is that called again? A refi cash out?
This was a refi cash out that they did. Hmm.
So the benefit of that, if you want to consolidate and pay off all your debt and you roll everything into one and just have one payment, which
Yeah.
is probably smaller.
The only thing with that, it resets the term, but you can get different terms. So This particular gentleman, it reset to 30 years. But you can get shorter terms, 15-year term, 20-year term, whatever makes sense.
Okay. Okay.
Mm-hmm.
Okay. Very good. All right. So I have another question.
Mm-hmm.
Let's see what this one is. This one is just came in. Someone said, okay, do your mortgage company offer any special programs and or loans for first-time homeowners?
Yes, actually, we do have one specific to movement mortgage called the Movement Boost that allows buyers to finance their entire down payment. This is only for FHA loans and VA. If their down payment is 3.5%, they can finance 5% of the purchase price. So if the purchase price is 500,000, they can finance up to $25,000. 3.5% would go towards the down payment, and the other 1.5% would go towards closing costs. So, this is not a forgivable loan, nor is it a grant. This is a loan that you would need to pay back, but it's for those that don't have the ability to save over a period of time because their rent may be too high to prevent them from doing so. So this helps them get in the door, and then eventually they'll do a refi or have enough money to pay off what they've borrowed and just focus on their mortgage.
Okay.
We
Okay.
also have a program that we partner with the state of New Jersey that will allow us to provide a forgivable loan up to $22,000. So in Union County, Essex County, Middlesex County, you would be able to receive $15,000 to be applied towards the down payment and closing. And then if you're first generation where your parents have never owned a home, you would be able to get an additional $7,000.
Oh,
So,
so it's 15 plus 7?
yeah, so that's up to $22,000. I recently had a buyer interested in renting, but the realtor suggested, why don't you see if you would be eligible to purchase and be able to take advantage of this particular program. So they end up doing that. They received $22,000, so their entire down payment was covered, a portion of their closing costs. They also received what's called a seller concession of $10,000, and they were in the door literally with less than what they would have paid for 1 month's rent, 1 month security, and 1 month finder's fee.
Wow.
Mm-hmm.
Okay.
Mm-hmm.
Interesting.
Mm-hmm.
Okay,
Yep.
I'm going to take a question from one of the listeners.
Sure.
Are there any grants that pay 5% of purchase price or pay down payments for or pay down payments? Yeah.
For down payments.
Are there any grants that pay 5% of purchase price or pay down payments for the purchase of a home?
So municipalities have certain programs that will allow you to get these type of grants. Some of these grants come with restrictions, some of them being income restrictions or occupancy restrictions. The program that I was speaking of with the state of New Jersey, it is a forgivable loan. You do not make any payments during the course of that loan. However, it comes with restrictions. They would like for you to be in that property for 5 years. If in the event you refinance or want to take advantage of the lower rates because the rates have dropped, then you would have to pay the money that they had given you back. So they want you to keep with the terms that they've given you for 5 years. That's an occupancy restriction. And then there's income restrictions. So certain counties are capped at a certain income bracket. So, you may not even be eligible for those programs, depending upon how much income you make.
Okay. Do you
But
provide? I'm taking another question from the listeners. Listeners, please just type your questions in the chat, and then I'm reading them right off the reels. Do you offer loans only in New Jersey?
no, Movement is licensed in 50 states. So if in the event you're interested in anywhere outside of New Jersey, I could definitely facilitate that process and put you in touch with the representative from that state that you're interested in.
Okay. How is the process for purchasing a property if you have some savings, but you have student debt?
Yeah, so I finance a lot of people with student debt. Student debt doesn't prevent you from purchasing a property. How we look at as a lender student debt is if, for instance, you're going to purchase a property with an FHA mortgage and there is no payment on the credit report, then we have to take the balance of that debt and charge you 0.5%, even if that student loan is deferred. So that 0.5%, say it's $1,000, right? Instead of 1%, which would be 100, we would only take $50 of that and have that be a portion of your debt. So it may not be that you would be able to qualify for more without it, but with it, it's probably a little less buying power. But it doesn't prevent you from owning, you know.
Okay. Can you remove an ex-husband from your mortgage or deed?
Yes, you can do what's called a quick claim deed, but the husband would definitely have to sign off on it, you know.
Okay. Um,
If it's a marital residence, the husband would need to sign off on it.
there's no longer a marriage. They divorced. The ex-husband is divorced, and the name of the ex-husband was still on the deed of the house that the other spouse maintained and lived in.
A
So,
quick claim deed,
okay,
they would have to sign off on it though.
the other spouse would have to sign off. Okay,
Hmm.
okay. How loans handle? Okay, you answered the how loans are handled situation. Let's see what else questions there's up here. There was something else here. Trying to go through the thread. Okay, let me go back to my emails because I do have emails as well. Okay, here's another question. If you refinance your mortgage just to get a better interest rate and or some money to renovate. Wait, let me see. Wait, do you have a mortgage? No, wait, does your mortgage company offer special programs for okay, you said that. If you want to refinance your mortgage just to get a better rate or or take out money for some renovations, I guess that's the question. Do you do that?
Well, yes, that's a twofold question. So when we're doing a refinance, it has to make sense. It has to be a benefit to the client. So the benefit is that you're doing a refi cash out because you need the cash. That's a benefit. Or for a lower rate, the payment would need to be lower for it to, make sense and be a benefit to you. So yes, we do both.
Okay. Do your mortgage company offer any kind of advice to tell a homeowner how to pay off their mortgage in 20 years instead of 30 years?
Yes, I do have a spreadsheet that I share with my clients so they can just plug in the amount that they're looking to pay every month or once a year, and then it'll re-amortize itself and show you how many years or months that you have left remaining of purchase of a mortgage. So yes.
That's great.
Mhm.
Okay. Another question here. Are there any other questions on from the listeners? Please text your questions in the chat. I don't want to always read everything from the emails, but this is not rehearsed. She's being very authentic and she's delivering you with some great nuggets. So it'd be great if you have questions, because I'm sure there's questions that you may have. I'm going to ask the question, what about credit?
You don't need the 800. I mean, it's always best to have a higher score to get the benefit of a better rate, or products that may not be available for somebody with a 580. But yeah, if need be, we do go down to a 580. I can't hear you.
On mute. That's really odd, but okay,
Yes.
no problem. No problem.
Okay.
So I guess your scores, your interest rates might be higher if your
Yes.
credit
Hmm.
card, if your credit score isn't more acceptable.
Yes. Well,
Okay.
not acceptable if your credit score is a 580, the interest rates may not be the interest rates for someone that's a 720,
What's
and you may not be eligible for certain programs, like the down payment assistance program requires a 620.
what is
So
considered
mhm,
a paper? What credit score is considered a paper?
680 and above, 720 preferably.
Okay. On
If
all three.
there's certain, just so you know, if there's certain issues with the credit that the borrower is working on, there's something that we assist the buyer called lending hands, where we assess
Mhm.
the, an action plan on what they need to do with their credit to get an increase in score. If in the event the action plan is followed, then we take the information that they have of how they paid this debt, they provide a new statement, and then we share it with the credit bureaus to do what's called a rapid rescore. Um, we do that for clients that, need to move sooner than later.
So, from what I'm gathering from your process, is that you not only help people get into a home by providing them with an approval, but you also navigate and hold their hands if their credit is below par. You're like a guided tour guide, if you would. You help them through
Yeah,
the whole process.
I mean that's what it's all about. It's a process. For some people, the
Okay.
longest client that I've worked with was I think 7 years.
Mm-hmm.
But certain things happened in their life that they couldn't move forward, but they eventually moved forward. And the thing is, I can't want the house more than
Right.
you as the buyer.
Right.
So I'm here to help.
Right.
I'm here to help you navigate these spaces, but I can't want it more than you. So if you're putting in that work, I'm putting in that work with you.
Very good. Okay, I'm going to go back to the email because it seems like I had one person come on. Here we go. If you finance a loan for your home with a private lender, let's say around 75,000, would you recommend refinancing with a bank or a loan company?
Well, it depends upon what you're looking for. What's the reason why you got the private lender? Are you an investor? Are you non-documented in terms of your income? Um, and then we need to find out whether you would be able to switch to a conventional or traditional type of mortgage, that being FHA, conventional, VA, USCA, or whatever the traditional mortgage products are. Private lenders do different types of financing. At Movement, we also offer some type of private lending. It's called non-QM products, and these are the non-qualified mortgage products that don't fit in the wheelhouse of conventional and FHA. These are more for the self-employed and the investor and the people that have just don't have documented income. we do have a loan that we don't need any income at all. No income, no employer. But with those programs, it's not like those programs you're going to be able to obtain down payment assistance. It's either one or the other. So you would need to have the liquidity for the down payment. You're probably talking about 20 to 25% in some cases.
Okay. Understood.
But yeah, we for the private lender, I mean, traditional mortgage is always, the best bet. But if you don't fit in that, if you don't have that credit profile to do that, then you have to get the next best thing that's going to get you out of that hard money,
Okay. This is a question for non-qualifier products, QM products. If you wanted to refinance to get to a lower interest rate, how much money are you allowed to pull out?
Are you an investor or are you a primary residence?
Investor?
Investor?
Mm-hmm.
Well, they'll do 70% loan to value. So, yeah, you loan to value 70%.
Okay.
It depends. It depends upon your credit score, depends upon the type of property, but usually it's 70%.
Okay. Have another question. Do your mortgage company offer any kind of advice to tell homeowners how to pay? I already asked that one. Do your mortgage company offer modification loans or some kind of help if a homeowner is experiencing hardship due to losing their job?
So you would need to go back to the servicer, the person that is the company that is servicing your loan, taking your payments month after month. They should have some type of solution
Mm-hmm.
to share with you on how to modify and restructure your mortgage. Typically, if it's an FHA mortgage, they'll take um, they'll take the past due payments and put it on the back end of the mortgage, right? You won't
Mm-hmm.
have to pay that back if you don't refinance. But if you end up wanting to refinance because you've gotten into a better position and the rates are better, you've shown a history of paying your mortgage after a year, that would allow you to do a refinance, that you would need to pay off that part that they put on the back along with refinancing.
Okay.
hmm
Okay.
And the value would need to be there to do that.
Okay. Okay. That's good stuff.
Yeah, a lot
Are
of people refinance also when they want to convert their FHA mortgage to a conventional mortgage, because since the values have grown year over year, 5%, sometimes in certain markets more than that, they want to convert their FHA to a conventional. And the reason why is because now they have 20% equity and they can get rid of the PMI.
Why don't you
Private
explain
mortgage
PMI? Yeah.
insurance.
I was gonna say,
Yeah,
can you explain
PMI
PMI?
is private mortgage insurance. It's something that is tacked on to your mortgage payment, not so necessarily for you as the buyer, but to protect the investor if in the event there's a default, right? So there's PMI, upfront PMI for FHA, and there's also a monthly PMI that borrowers would have to pay when they're putting 3.5% down. The PMI is for the life of the loan. If you put 10% down on an FHA mortgage, the PMI is removed at the 11th year. So an FHA is a good mortgage for those that just want to get in where they fit in. But it's a mortgage that you want to get in and then have an exit strategy eventually. Maybe you needed to get into that program because your score was on the lower side, or maybe you didn't have a significant amount of money for the down payment. Whatever the case may be, it's not a loan that you want to sit in because the PMI is for the life of the loan now. So you want to eventually transition out of that and refinance into a conventional mortgage, especially if you have to have the equity.
Okay. Okay. Um, with regards to purchasing a home, what is the minimum amount of money you need to put down as a down payment?
Well, they have conventional programs that will allow you to put down 3%, and then they have FHA that will allow you to put down 3.5%. You know, it depends on what type of credit profile you have, on what program would fit best. If you have a lower score and you're doing a conventional mortgage, your PMI sometimes is double than what it would be for FHA. So if I know, in your real estate world, the realtors, Felicia, may say, I just want a conventional pre-approval. But asking for conventional pre-approval may not be a good thing for the buyer, because now their monthly PMI could be double than what it would be for FHA. And if they're trying to be cost effective, going conventional would not be cost effective for them. This doesn't apply for everybody, but it's for certain people that can't get a conventional mortgage. And also, I want to say, now that we're doing a side-by-side comparison, FHA will allow you to increase your buying power by 7%, whereas conventional, it will allow you to, it's a hard stop at 50% of whatever your housing expense and your monthly expenses on your credit report. That's called debt to income. On FHA, they'll allow you to go up to 56%, right, of your gross income to be allotted toward your monthly expenses and your mortgage, right? Not to say that we want to max everybody out, right? But that certain families are coming with the generation, right? So they have mom and dad helping with the mortgage. They have a brother coming in to help with the mortgage. They have all these people coming in to buy this generational home, but not everybody's going on the mortgage necessarily. So it would need to make sense on, whether it's affordable to do that.
Okay. I have another question. If you are approved for a reverse mortgage, can that affect your VA benefits in terms of being exempt for paying the property taxes?
No, you're still a vet. When you pay your property taxes as a vet, you have to be 100% disabled, right? So if you're 100% disabled, I believe it still applies regardless of whether you have a VA loan or not.
So if you're a widower of a vet that was 100% disabled, would that apply as well?
I believe they still have the benefit, yes.
Do seniors have to disclose all personal information when applying for an apartment in a senior development? Like if they have a house and they're gonna put their house for sale, do they have to disclose that information?
It's not my wheelhouse. I don't know.
Okay.
If they're not buying a mortgage, right? They're not using. No,
No,
that's like,
but they have a house. They were wondering, do they have to disclose their personal information if they were going to get something in a senior apartment, senior
oh,
complex?
I wouldn't know that. No, I don't know.
Yeah, it depends on what it says. Okay. Another question coming in from someone is, if someone wanted to purchase a house for 500,000 and you wanted to put down 150 down payment, would that make a difference in your mortgage payment, or would it recommend putting down that much money?
Well, it's all according to what you want your monthly mortgage payment to be, and the reason why you're putting down $150,000. So, just a rule of thumb: for every $10,000 in down payment, it would be roughly around $60 difference in payment. So, you have to decide on, number one, what's the reason for you putting down 150,000? Is it to have a lower payment, to get rid of PMI? On 150,000, that 20% is 100,000. So you wouldn't have any PMI with $100,000 down, and probably an additional $20,000 for closing costs. So that would be 120